Welcome and hello. I'm Tom,
And I'm Amy.
and we're here to unpack some really fascinating developments for you today.
Yeah, we're diving into a pretty critical moment in global economics, trying to pull out the key details and, connect the dots for you.
Exactly. Today, we're really focusing on the recent financial market volatility, specifically how these new tariff threats are, well, reshaping the global economic picture.
We'll be looking at how the markets are reacting, some interesting shifts in commodities, and what it all might mean for different sectors and economies.
Our mission really is to take all these latest reports and just boil them down.
Right, so you can quickly grasp what's really going on without getting bogged down in all the jargon. You should walk away feeling, well, pretty well informed about the forces at play.
Okay, let's unpack this then. The core of it all seems to be this escalation in the trade situation, specifically new tariff threats coming from the U.S. president.
Yeah, and what's really striking is the ripple effect, how quickly these announcements spread through the system. First, it was pressure on Canada.
Right, that 35% tariff threat
Yeah.
meant to hit by August 1st.
Exactly. But then things really ramped up over the weekend.
Yeah, Saturday. That's when the president expanded it, indicating intentions for 30% tariffs on Mexico and the European Union, also starting August 1st.
And communicated how? Through letters posted on social media, which is, well, quite a way to conduct trade policy.
It certainly gets attention.
It does, and it
Indeed.
raises that big question, what's the actual strategy here? I mean, the letters did offer a little bit of wiggle room.
How so?
Well, they basically said, if you wish to open your heretofore closed trading market and eliminate your tariff barriers, we will perhaps consider an adjustment. So maybe some negotiation space?
Perhaps. And for Mexico, there was a mention of their border efforts, but still a call for more action.
Right. So how did the other side react? The EU.
Well, European Commission President Ursula von der Leyen, she responded pretty quickly.
And what was her take?
She warned these 30% tariffs would, and I'm quoting here, disrupt essential transatlantic supply chains, harming businesses and consumers on both sides.
Makes sense. Did she mention retaliation?
She did. She said the EU would take all necessary steps to safeguard EU interests, including proportionate countermeasures.
And they have plans ready, don't they? The EU's got existing lists.
Exactly. One list targets about 21 billion euros of U.S. goods. Another one's ready for maybe 72 billion euros. They could even look at export controls.
But then things seemed to shift slightly on Sunday.
Yeah, interestingly, the EU appeared to, well, soften its immediate stance a bit. They extended the suspension of their current countermeasures until early August.
Pushing for negotiation instead.
Seems like it. And that new anti-coercion tool, the ACI, von der Leyen said it's for extraordinary situations.
Implying this isn't quite there yet.
Her words were, "We are not there yet." So dialogue seems to be the preferred path, for now at least.
Okay, so these threats are hanging out there. How are the markets actually handling all this?
Well, our sources are calling it the fog of war, which feels pretty apt. There's significant volatility driven by these trade headlines, but also other geopolitical risks.
Like the U.S.-Iran friction, that's definitely hitting energy markets.
For sure. And we saw that volatility quite clearly last Friday in the U.S. stock markets.
Right, the indices pulled back. S&P 500 was down, what, about a third of a percent?
Yeah, to 6,259.75. And the NASDAQ 100 fell about 0.21%.
The Dow took a hit, too, dropped about 279 points, or 0.63%.
And that capped off a generally down week for investors. The S&P lost 0.31% over the week, the Dow fell 0.83%, and the NASDAQ was down just slightly, 0.08%.
It was a tough week. But here's where it gets kind of interesting. The underlying earnings data tells a slightly different story.
Oh, so?
Well, for Q2 2025, year-over-year earnings are actually expected to be up pretty decently, too, like 5.7% or even 7.5% if you strip out the energy sector.
Right.
And look, of the companies that have reported so far for Q2, over 71% beat analyst expectations. That's better than the long-term average.
And revenues, too. Any good news there?
Yeah, similar story. Revenue growth for Q2 is estimated at 3.8%. Or over 5%, excluding energy.
Wow.
And an impressive 81% of companies beat revenue expectations. Compare that to a long-term average of just over 62%.
So current performance looks strong, but the market's reacting nervously to the future threats. Is that the disconnect?
That seems to be it. It raises this important question about future sentiment, right? We've seen way more negative guidance than positive.
How many?
70 negative EPS pre-announcements from S&P 500 companies for Q2 versus only 46 positive ones.
That's a noticeable gap.
It is. And the forward PE ratio for the S&P 500, it's sitting at 22.4, which is, historically quite high, suggests investors are still banking on future growth despite the jitters.
And we've got more earnings coming up this week, right?
Yep, about 37 S&P 500 companies reporting, so that'll give us more clues.
Okay. Any specific company news catching your eye?
Well, Levi Strauss jumped 11%. That was after they raised their forecasts.
Nice move for them.
Definitely. But then Meta, Facebook's parent, closed down over 1%. Reports suggest they're not likely to change their payer consent model much.
Ah, potentially more EU antitrust trouble ahead then.
Could be. And Kraft Heinz was up about 2.5% on reports they might be preparing to break up the company.
Interesting times for them. What about sectors? Any standouts or laggards?
Energy was actually the best performer within the S&P 500 last week, up almost 0.5%. Companies like Halliburton, Baker Hughes saw gains.
Okay. And the worst?
Financials, they were down a full percent. Think American Express, Progressive Core, those types saw drops.
And the tech megacaps? Always worth watching them.
Kind of a mixed bag, really. Alphabet, Amazon, Microsoft, Nvidia, Tesla, they were up.
But not all.
No, Apple and Meta were down. It just shows, even with these big market waves, individual company stuff still matters a lot.
Absolutely. Okay, let's shift gears a bit. Away from stocks, what about commodities and currencies? How are they reacting?
Well, gold, the classic safe haven, it definitely reacted. Jumped over 1% on Friday, hitting $3,356 an ounce.
And that was directly tied to the tariff news.
Sources specifically noted it was a reaction to the president's new tariffs on Canada, and Brazil was mentioned too. And year to date, gold's performance is pretty stunning, up over 27%.
Wow. And silver, did it follow?
Oh, big time. Silver surged nearly 5% to over $39 an ounce. That's its highest level in, more than 13 years?
That's a huge move. Really shows investors running for cover.
It really does. And oil prices moved up, too.
Right, WTI crude.
Yeah, WTI rose almost 3% to $68.58 a barrel. Brent was up about 2.5% to over $70.
What was driving oil? Just general uncertainty or something specific?
Market attention seemed focused on the U.S. president warning about a, quote, major statement on Russia coming Monday, plus criticism of Putin.
And there's that sanctions bill in the Senate too, right? The
Yeah.
one targeting China and India if they buy Russian energy.
Exactly, with huge 500% tariffs proposed. That's definitely adding another layer of complexity to energy markets.
But isn't the longer-term demand picture looking a bit weaker? I thought the IEA had forecasts on that.
You're right. The International Energy Agency, the IEA, they expect global oil demand growth to slow down quite a bit. Slowest pace since 2009 if you exclude the pandemic dip.
And they're linking that to tariffs.
Yeah, they mentioned early signs that U.S. tariffs are starting to weigh on economic activity globally. Their projection is for demand to grow by about 720,000 barrels a day, reaching 104.4 million barrels per day in 2026.
Okay, so demand growth slowing. What about supply? Is that tightening?
Actually, no. The IEA expects global supply to rise by 2.1 million barrels per day this year. That's higher than they previously thought.
Implying a surplus then.
Potentially, yes. And they pointed out Saudi Arabia ramped up production quite significantly last month, way above its OPEC plus quota.
Really? By how much?
Around 700,000 barrels a day extra, and most of that, about 70%, got exported. This was happening as tensions flared, particularly with Israel and Iran.
Interesting. So even though OPEC Plus decided to unwind cuts faster, the IEA thinks it didn't really move the needle.
Yeah, they said it failed to move markets in a meaningful way given tighter fundamentals. Suggests the markets may be looking past those OPEC decisions right now.
Okay, let's look at currencies. How did the dollar fare amidst all this?
The dollar actually gained ground against most other major currencies on Friday. The dollar index was up 0.22% for the day,
For the week.
up 0.70% for the week. It also had its biggest weekly gain against the Japanese yen since back in December 2024, up 0.80%.
So dollar strength. What about the euro and sterling?
The euro dipped slightly, about 0.05% down to 1.1696. That seemed linked to Trump saying the EU might get a tariff letter soon.
Okay. And the pound?
Sterling fell more noticeably, down 0.60% to 1.34988. It hit near two-week lows.
Why the drop there?
That was largely due to data showing the UK economy unexpectedly shrank for a second month running in May.
Ouch. Okay, one more market before we move on. Bitcoin. It's been making headlines.
It sure has. Hit a new record high on Friday, briefly touching almost $119,000.
Wow. before settling back a bit.
Yeah, ended around $117,732. The drivers seem to be growing institutional and corporate interest, plus maybe sense of a more positive regulatory environment developing in the U.S.
Okay, fascinating moves across the board. Let's bring it back to the fixed income markets then. Treasury yields, what happened there?
U.S. Treasury yields actually rose on Friday. The 10-year yield was up 7 basis points, finishing at 4.42%.
Reflecting inflation fears from the tariffs.
That's the main interpretation, yeah. Concerns that these tariffs could push prices higher. The 30-year yield also climbed, up 9 basis points to 4.95%, almost 5%.
Hmm. So how does this square with what the market expects the Fed to do? Are rate cut expectations changing?
Well, it's interesting. Fed funds futures traders are now pricing in a slightly higher chance of a July cut, about 6.7%, up from 6.2%.
But still not the most likely scenario.
No, September is still seen as the front runner for a cut, with about a 60% probability priced in. Overall, traders are expecting roughly 49 basis points of cuts by the end of the year.
So the market's still leaning towards easing later this year, even with these yield moves.
It seems so. Maybe betting the Fed will have to react if the economy slows down due to the tariffs, despite the immediate inflation concerns.
And what are Fed officials themselves saying? How are they reading the tea leaves?
Chicago Fed President Austin Goolsbee put it, quite frankly. He said in a recent podcast, the new tariffs caused a lot of anxiety and made interpreting the economy, quote, messy.
That sounds about right.
Yeah. So now all eyes are on Tuesday's CPI report. That's the Consumer Price Index.
Crucial for seeing if companies are passing on those potential tariff costs.
Exactly. That report could really sway thinking about the Fed's next move. For now, the expectation is they'll stay on hold, wait and see how these price pressures play out.
Okay, what about bond yields over in Europe? Did they follow the U.S. higher?
They did, yes. In the UK, the 10-year gilt yield rose 3 basis points to 4.62%. That weak GDP data we mentioned definitely played a role there.
Right, 2 straight months of contraction.
Yeah. And Eurozone bond yields were up too, as everyone waited for that potential tariff letter from the U.S. Germany's 10-year bond yield finished up 2 basis points at 2.72%.
And the European Central Bank, the ECB, any clear signals from them?
A little bit of divergence, maybe. One governing council member, Fabio Panetta, suggested they should keep easing policy if trade tensions actually boost disinflationary trends.
Interesting take. Less demand equals less inflation pressure.
Potentially. But then another ECB board member, Isabel Schnabel, sounded more cautious. She said the hurdle for another rate cut was very high.
Why is that?
She noted the Eurozone economy seems to be holding up better than expected, even with all this tariff uncertainty. So the ECB seems to be weighing different factors pretty carefully.
Right. And finally, let's circle back to that UK economic data you mentioned. GDP falling for 2 months.
Yeah, that data from the Office for National Statistics showed GDP down 0.1% in May after falling 0.3% in April.
And that followed some tax hikes on businesses.
Exactly. Tax increases kicked in back in April. This whole situation puts the Chancellor, Rachel Reeves, in a bit of a tight spot.
How so?
Well, there's pressure to potentially raise taxes again in the autumn budget to fill a fiscal hole that estimates suggest could be over $20 billion.
But businesses are probably pushing back hard against that.
You bet. Business leaders are warning that hitting them with more taxes right now will just stifle growth even further. It's a really difficult balancing act.
Definitely sounds like it. Okay, so wrapping this all up, what's the big takeaway for our listeners?
Well, I think it really underscores just how tightly everything is connected, doesn't it? Global trade, geopolitics, market movements, stocks, bonds, commodities, it's all interwoven.
Yeah, a policy announcement here, a tweet there, and you see these ripples spread out almost instantly across the financial world.
And it highlights how quickly things can change. Economic forecasts, market sentiment, it can all pivot based on these political developments and trade stances.
Those ongoing negotiation attempts, and especially that upcoming CPI data on Tuesday.
Absolutely crucial. Those will be key signals for understanding the path forward in what are, let's face it, pretty turbulent times.
So for you, the listener, we really hope this discussion gives you a clearer picture of all the complex forces shaping the headlines you're seeing every day.
Thanks for your attention. You can subscribe our podcast if you like it. See you next time.